Okay, so now we have the recording going. All right, so it's Thursday, and we are, let's see, are we done with chapter 2? Let me take a look. I gotta grab the book here. Sort of dark in my little corner where I'm sitting right now, but oh, we had homework. That's what we had, right? We had some homework for the end of chapter 2. And so you guys should have put that in already. So why don't we take the time to go over the homework? So it was what, 1, 12, 21, and 28, I believe, what was the homework assignment. So let's take a look at question number 1. And per my book, let me see if I turn this light just a little bit better. All right. Okay, Frantic Fast Foods had earnings after taxes of $420,000 in 20X1 and 309,000 shares outstanding. On January 1st, 20X2, the firm issued 20,000 new shares. Because of the proceeds from these new shares and other operating improvements, earnings after taxes increased by 30%. A, compute the earnings per share for the year 20X1. So 20X1 is the year before we issued the new shares and before the improvements. Okay, so we have earnings after taxes in 20X1 of $420,000. We have 309 outstanding shares. That's pretty quick and easy. You just divide the earnings after taxes by the number of shares to come up with earnings per share. So I believe that the earnings per share is $1.36. Okay, anybody think different? If not, moving along. B, compute earnings per share for a tax year 20X2. All right, so the difference here is that we have the changes in the earnings after taxes. So we had a 30% increase in earnings after taxes, which would take us from $420,000 to $546,000 in earnings after taxes. We now have 329,000 shares outstanding. So you divide the 546 by the 329, and you come up with, I think my rating here is $1.66. So this is an instance where we had an improvement in the earnings per share because of the additional investment in the company. This is one of those times, you have to be cognizant or aware of the fact that by raising additional capital through the sale of stock, what you're doing is you're diluting the shares that were out there prior. So the original 309,000 shareholders, they now own a smaller portion of the company. So this worked out good because the improvements were positive enough that it was able to overcome the additional dilution. So earnings per share went from $1.36 to $1.66, which is a good thing. All right, question number 12. All right. Lemon Auto Wholesalers, they might want to consider changing that name, had sales of $1 million last year, and cost of goods sold represents 78% of sales. Selling and administrative expenses were 12% of sales. Depreciation expense was $11,000 and interest expense for the year was $8,000. The firm's tax rate is 30%. Compute earnings after taxes. All right, so we have enough information to do that. So we have sales of $1 million. Cost of goods sold is 78% of cost of sales. So that's going to be $780,000. That leaves us gross profit, sales minus cost of goods sold, of $220,000. Let's see, selling and advertising expense was, what did they say, 12% of the sales, so that would be $120,000. Depreciation was just a hard number of $11,000. That leaves us an EBIT, okay, earnings before interest and taxes, of $89,000. So 220 minus 120 is 100, minus 11 is 89. Okay, interest is $8,000. They gave us that number. That's a hard number, 8,000. So 89,000 minus 8,000 is $81,000. So that's earnings before taxes, earnings EBT, earning before taxes. And then tax rate is 30%. That's going to be $24,300. So we subtract that from the 81,000. We get earnings after taxes of $56,700. All right. Now, part B. Assume the firm hires Ms. Carr, an efficiency expert, as a consultant. She suggests that by increasing selling and administrative expenses to 14% of sales, sales can be increased to $1,050,900. So an increase of $50,900. This effort will also reduce cost of goods sold to 74% of sales. There'll be a larger markup in prices as a result of more aggressive selling. Depreciation will remain at $11,000. However, more automobiles will have to be carried in inventory to satisfy the customers, and interest expense will go to $15,800. The firm's tax rate remains at 30%. Compute revised earnings after taxes based on Ms. Carr's suggestions for Lemon Auto wholesalers. Will her ideas increase or decrease profitability? All right. So now what we end up with is new sales of $1,050,900. Cost of goods sold is now 74%. So that gives us $777,666 for cost of goods sold, or gross profit of $273,234. Then we have selling and administrative expenses. Now that has gone to 14% of sales. So that's $147,126. Depreciation remains at $11,000, which gives us EBIT of $115,108. Interest is now $15,800 because we have to have more vehicles in our inventory. Subtracting that from EBIT, we end up with $99,308 as earnings before taxes. Taxes, 30%, so $29,792. Gives us earnings after taxes of $69,516. So that's a little less than $13,000 of increased profit. So our efficiency expert, Ms. Carr, actually was effective. So we should adopt her process. All right. The next one was number 21, I guess. All right, 21. The Rogers Corporation has a gross profit of $880,000 and $360,000 in depreciation expense. Evans Corporation has $880,000 in gross profit with $60,000 in depreciation expense. Selling and administrative expense is $120,000 for each company. So what I did was I set this up in two columns. First column had Rogers, the second column had Evans. Gross profit, you see it's the same for both companies, $880,000. Depreciation for Rogers was $360 and Evans was $60. Selling and administrative expenses was $120 for both companies. Now, because of the significantly higher depreciation for Rogers, the EBIT was different between the companies. So EBIT for Rogers was $400,000 and $700,000 for Evans. Now we take the tax, and they said it was at 40%. So the tax for Rogers is $160,000. The tax for Evans is $280,000, which leaves us earnings after taxes for Rogers of $240,000, for Evans of $420,000. We have now, in order to get cash flow, we have to add back in the depreciation, because once again, depreciation is a non-cash expense. So Rogers, we add back in the $360,000, which brings our cash flow to $600,000. Evans, we add back in the $60,000 of depreciation, and we get cash flow of $480,000. Now, the point of this problem is to illustrate the use of taxes to help fund your company. Okay, so the depreciation is a non-cash expense. All of the cash expenses between the two companies were identical. So you would think at the end that you would end up with the exact same cash flow. The problem is, the difference is that depreciation, even though it gets added back in because it's a non-cash expense, is deductible for tax purposes. So the taxes were what, $120,000 less, because, well, it's the $40,000 of the difference between the two companies. Rogers had $360,000 in depreciation. Evans had $60,000 in depreciation. So it's a difference of $300,000 in depreciation. So the tax rate times the difference in the depreciation is $120,000. So it reduced the Rogers tax was $120,000 lower than Evans tax because they had the depreciation expense, which means that our cash flow is going to be $120,000 higher because we paid $120,000 less in tax. Okay, so, and that's illustrated perfectly because Rogers has $600,000 in positive cash flow. Evans has $480,000 in positive cash flow. That's the $120,000 difference that came purely from the difference in the income tax. All right, number 25, which is the biggest problem that we had. All right, or 28, excuse me, 28. Refer to the following financial statements for Crosby Corporation. So we have Crosby Corporation represented in the book. Prepare a statement of cash flows for the Crosby Corporation using the general procedures indicated in table 2-10. Okay, so doing that, I'm going to turn to the actual financial statement. Crap. All right, sorry, I dropped my keyboard and it shut off my my computer for a minute there. Push the keyboard back out of the way. Or just put it on the floor. Okay. Man, I'm having trouble today. All right, so looking at the income statement, we have, I'm not going to go through each line, but we end up with is earnings available to common shareholders. Actually, earnings after taxes is where we want to be, the $160,000. So we have $160,000 worth of net income, okay? It's earnings after taxes. Now what we have to do is we have to do our adjustments. Now, remembering the way that the book tells us to do it, it's a three-step process. We have the operating cash flow, we have the investment cash flow, and we have the financing cash flow. So let's start with the operating cash flow. The first thing we have to do is add back in our depreciation. So looking at the income statement, we see that we have depreciation expense of $150,000. So we have to add that back in. Then we have to look at the difference in accounts receivable. Okay, so accounts receivable, that means we have to go to the balance sheet, the comparative balance sheet. We see that inventory went from $410,000 to $430,000. So that's an increase of just looking at the wrong thing there for a second. The accounts receivable went from $300,000 to $350,000, excuse me, but it was an increase in accounts receivable. So that does what to cash? If we increase accounts receivable, that means we're lending money to our customers. So that means our cash is going to go down. So it's a negative $50,000. Inventory goes from $410,000 to $430,000. So that is a increase in inventory. An increase in an asset means that we had to pay for that somehow. So that's a reduction in cash, so negative $20,000. Prepaid expenses. We have a beginning number of $50,000 and ending number of $30,000. So we have a reduction in an asset. A reduction in an asset means that we turn that into cash somehow. So that's going to be a positive effect on cash flow of $20,000. Then we have to look over on the liability side. Accounts payable goes from $250,000 to $440,000. That's a significant increase in money that we owe to our trade creditors. But an increase in a liability gives us cash. Okay, so an increase in accounts payable increases cash. Now that is a $190,000 swing. We have accrued expenses of a movement from 70,000 to 50,000. So that's a reduction of a liability. So a reduction in accrued expenses means that we lose $20,000 in cash. Notes payable, if you look at it over on the liability section, started at 400, ended at 400. So we don't make any adjustment for that. That is everything in the operating cash flow. So we have an increase in 150, a decrease of 50, a decrease of 20, an increase of 20, an increase of 190, and a decrease of 20. That gives us a total increase of $270,000. All right, then if we go to the investment cash flow, what we want to do is we want to see what has happened to our long-term securities. So we're going to look at the assets side of this again. And investments, long-term securities, went from $80,000 to $70,000. So this is a reduction in an asset, which means it has to be an increase in cash. So that's an increase of $10,000. Then we need to look at plant and equipment. Plant and equipment went from $2 million to $2,400,000. That's an increase in an asset of $400,000. Well, an increase in an asset is a use of cash. So that's a negative, negative $400,000. So the total swing for investment cash flow is a positive 10,000, a negative 400,000. So it's a negative $390,000 in cash flow from investments. The final part of this is financing. And here is what we have to look at is we have to look at, first off, the bonds. We have bonds that we are using to help fund this company. And the bonds at the beginning of the year were $70,000. At the end of the year were $120,000. Well, that is an increase in liability, which means an increase in cash. So bonds payable is an increase of $50,000 in cash. Then we need to look and see, did we sell any new stock? Did we retire any stock? No. Preferred stock remains the same. Common stock remains the same. Capital paid in excess of par remained the same. The only different other things that we have to take into account then are dividends that we would have paid. Now, according to the first chart, we paid $10,000 to the preferred stockholders. So a payment of dividends, we used cash. You know, what did we pay them with? We paid them with cash. So that's a use of cash. So that's a negative $10,000 effect on cash. Then we need to look at the statement of retained earnings to see if we paid anything to our common shareholders. And as you can see, we show a cash dividend, excuse me, being paid of $50,000. So that, once again, paying dividends is a use of cash. So that's a negative $50,000. So our cash flow from financing activities is a positive 50, a negative 10, and a negative 50. So a total swing of a negative $10,000. So we have four numbers to add up here: $160,000 from income, positive $270,000 from operating cash flow, a negative $390,000 from investment cash flow, and a negative $10,000 from financing. So 160 plus 270 minus 390 minus 10 gives us a positive $30,000. So we had an increase in cash because of our cash flow of $30,000. And to check that, we just go and look at the balance sheet. Our beginning cash was 70,000. Our ending cash was 100,000. So that is an increase of $30,000. So we're correct. We have an increase of $30,000. Describe the general relationship between net income and net cash flows from operating activities for the firm. Well, operating activities, let's see. Of course, we add back in depreciation, so we're going to always have a nice little kick from the depreciation. The increase in accounts receivable means that we were a little bit more free with our credit that we extended to our customers. Maybe that was necessary in order to increase sales for this particular year. Hopefully, it was because of a decision we made as opposed to our customers just not paying us. Inventory, we had an increase in inventory, so maybe we are on some sort of a growth mode. So as a result, we needed to have a larger inventory. So hopefully we made that decision, and that's just not laziness that created that. The reduction in prepaid expenses, I don't know, that's just really, in my mind, an accounting transaction. I'm not too concerned with that change. The big change that's really interesting is that our accounts receivable went up by $190,000. That created a positive cash flow for us of $190,000 because we're using other people's money, right? We're using the money of our vendors. You know, they gave us the product and we have not yet paid it. So that is another one of those things. If we had somehow decided that we wanted to start extending our credit with our vendors, hopefully it's not that we're just deciding not to pay them because we don't have the cash. Hopefully it's because we either have grown in our business and it's just become organic that accounts payout accounts. Oh, I'm sorry. Yeah, that's accounts payable I'm talking about. Yeah. Hopefully it's something that was organic that just grew because of the fact that our business grew, or that we negotiated new terms that gave us a longer time to pay, whatever, but that was a massive change for cash flow. Accrued expenses, once again, that's an accounting entry. So that's how operations affected cash flow. The big thing there is, of course, the big increase in accounts payable. Has the buildup in plant and equipment been financed in a satisfactory manner? Briefly discuss. Well, like I said, if the increase in accounts payable was something that's not getting us into trouble with our customers, with our vendors, then it's fine. If we renegotiated what their terms were and they're happy with our payment history, that's fine. But if we made the decision to buy the additional equipment, or whatever it is that's in plant and equipment, at the expense of straining our relationship with our vendors, then that's probably not a good idea. Okay, so see, it's very interesting, the different things that you can take from a set of financial statements. Now, we don't know, from the finance department, we can look at this and say, well, we bought $400,000 worth of equipment, but we seemed to really have funded that with an increase in our accounts payable. Is it dangerous to not pay your vendors when they expect to have you pay them? Yeah, absolutely it is. You rely on that credit from your vendors. If you stop paying according to the terms, there's a chance that they're going to stop selling to you, or there's a chance that they're going to raise your prices, or you don't want to have a bad relationship with your vendors. So from the finance point of view, we see that was what happened. And maybe what we need to do is we need to talk to somebody to see, if that was something that was planned, if that was something that is okay with our vendors. But it's something we really should be looking at. All right. Compute the book value per common share for both 20x1 and 20x2 for Crosby Corp. You know what? I'll be honest with you. I didn't bother doing that. So you can do that if you like, but I didn't bother. All right. Any questions about the homework before we move on to chapter 3? Chapter 3 are the ratio analysis of a company. I'm not going to do the entire chapter, just the beginning part of the chapter where we talk about the various ratios that are out there. I will hold you responsible for the ratios on the test that we're going to have, which is probably going to be Tuesday, depending on how far we get today. But the one thing that I tend to do, what's this? Calculator. Oh, well, weird. The one thing that I tend to do is I tend to allow you to have a cheat sheet that you write all the ratios down. I don't need for you to memorize them. It's the type of thing you can certainly look up at any time. It's the concept of what they represent that is important. The math, I expect that you can do the math, but I just want you to be able to know what numbers you have to pull in order to get to the various ratios. Okay, so you will be held responsible for the ratios on the exam, but make yourself up a nice cheat sheet with all the ratios and what their names are and what numbers you need in order to calculate that ratio. Okay. All right. That being said, I guess I should take attendance. I haven't done that yet. So let's take attendance just to say that I did. Emily Baker, you're out there. I see you. Matt Castles, I saw you check in. Yep. Peyton Ennis.
I'm here.
All right. Evan Gerber. No,
I'm
Evan?
here.
Oh, there you are. I was going to say, Evan, you're always in class. Travis Harvey.
Here.
Okay. Sayun Huang. Sayun. All right, oh, where she's here. Salam. Yep, he's here. Salam. Haruta Kuroda.
Here.
All right. Connor Lovick.
Here.
Destiny Merriweather.
Here.
All right. Jeremy Meyer. So Jeremy check in. Yep. Haley Phillips. No Haley. Okay.
I'm here.
Oh, there you are. Okay. John Retton. I saw you check in earlier.
Here.
Okay. Owen, I saw you out there.
Yeah.
And Lucas, I saw you check in. Okay, good. All right, good. All right, so that's taken care of.
Hey,
All right.
Professor Gomolchek.
Yes, sir.
On the test, do you want us to like memorize how the income statement is formatted and how the cash flow statement
Yes.
is? Like, are we expected to fill those accounts in, or do you want, or are you gonna have like a pre-formulated sheet and then we just fill the numbers in?
No, I think it's important that you be aware of what the proper form is, because as we go through this semester with this course, knowing how to get to gross profit, knowing how to get to EBIT, knowing how to get to earnings before taxes, earnings after taxes, I think that's important. So I do need you to memorize the format of the forms. Also, the balance sheet, of course, being the current assets, then the sort of the plant and equipment, current liabilities, long-term liabilities, owner's equity, all of those things are necessary. As you'll see when we get into the ratios here, if you have everything done according to the exact way that it's presented in the book, so for example, on the balance sheet, you state what your current assets first, because that's how we do it in terms of liquidity, and then total yourself at current assets. You'll see that some of these things we take current assets as one of the numbers in the ratio, and so if you have all of those subtotals when you go through these various ratios, become just a matter of plugging numbers into a formula. So yeah, I am going to want you to memorize the format of the various statements that we're using, but like I said, I'll let you have a cheat sheet for the actual ratios.
Okay. All right. Thank you.
No problem, Evan. All right, so let's take a look at the ratios that we're going to talk about. They're broken up into, there's 13 significant ratios that the book talks about, and there are four different categories in which they fall. The first one is profitability ratios. The second grouping is asset utilization ratios. The third one is liquidity ratios, and the fourth one is debt utilization ratios. Okay, so let's take a look at the ones that are under profitability first. There's three there. We have profit margin, return on assets or investment, and we have return on equity. Okay, so let's take a look at what these are. In your book, we have and let me see, I can probably bring this up. This is going to require me to use my keyboard again, so hopefully I won't drop it and disconnect us again. Gotta be careful what buttons I push on this portable keyboard. So give me a second. Let me get my book up. Excuse me. At least we can have the financial statements to look at together. Okay. Chapter 3. I'm hoping the numbers are right because I know that the version that I have access to is not necessarily the current edition. All right. Saxon Company. Let me get rid of the keyboard again, hopefully without disconnecting us. All right. All right, income statement looks right. Let me just check the balance sheet. Oops, I'm not going to use it for now. Okay. All right, so let me share this so we can all be looking at the same thing. Doo-be-doo-doo. Okay, so this is a Saxon Company that we're talking about. So let's take a look at the profitability ratios. So we have the income statement basically that we're going to be looking at first off here. So there it is. Hopefully you guys are seeing Saxon Company's income statement with $4 million in sales and $200,000 in net income. That's earning after taxes. All right, so the first one is the profit margin. And the profit margin is plain and simple, net income over sales. So all we have to do is we have to find the numbers and plug them into the formula. So net income, according to the income statement, is $200,000. Sales is $4 million. So we divide 200,000 by 4 million. And what we end up with is 0.055%. Okay. So the question is, what does that tell us? Well, in a vacuum, that doesn't tell us anything, okay? We need to have something to compare that to so that this becomes a useful tool to us. Various industries, depending on what type of business that you are in, will have different ratios that are common in that particular industry. Our book gives us things to look at, again, to charge or to compare Saxon against as far as industry average, okay? So what we're looking at is, according to our calculation, Saxon has a 5% profit margin. The industry average is 6.7. So we're not doing as well as others in our industry. And that's not a good thing because that means that our competitors are a little bit more efficient than we are, it appears. Okay, so the initial ratio here is not good news for us. Let's look at the next ratio. That's return on investment. Okay, and according to our book, there's two ways of doing this, but obviously I always take the easier way, which is going to be net income over total assets. All right, so our net income is $200,000. Excuse me. Total assets is right here, $1,600,000. So 200,000 divided by $1,600,000 is 12.5%. Okay, so we're getting a return on our investment. We're getting $200,000 worth of income on an investment of $1,600,000. That's really what that is telling us. So we're getting a 12.5% return. Now, as far as being able to compare where we should be putting money, 12.5% is a relatively decent return. Okay, so I'm happy with that. What does that, how does that compare with the rest of the industry? Now, according to our book and whatever industry that Saxon is in, the average there is 10%. So we're getting a 12% return on our assets where the rest of the industry is getting 10%. So what that seems to be saying is that we're making more efficient use of our assets because we're able to get a better return on our assets than our competitors. So we don't have to have as much money invested to come up with the same amount of income. Or if we had the same amount invested, we would have more income. So we're relatively efficient at the use of our assets. That's a pretty good thing. All right, the last profitability one is return on equity. Return on equity is net income. So all three of these ratios, we start with the numerator of the fraction being net income. Okay, so profitability has to be based on our use of our return or our net income. So the third one is net income over stockholders' equity. So what's our total equity? Total equity is $1 million. We don't have necessarily a subtotal of $1 million here, but what you do have is you have up here total liabilities being 600,000. We know everything on this side is $1.6 million, so our equity has to be $1 million, and you can find that by just looking at common stock of 400 and the retained earnings of 600. So there's our $1 million. Okay, so 200,000 over $1 million gives us a 20% return on equity. Okay, so equity is the amount of money that was invested in the company plus the retained earnings. Okay, what's our profit return based on that particular investment in the company? So that is a 20% return on our investment, our our assets. Excuse me, our equity. According to the book, it is 15% for the industry average. So once again, it seems like we're making very efficient use of our assets. Okay, so asset-wise, we ended up with 12%, beating the industry average of 10%. Equity-wise, based, that's with the money that we have invested, we ended up with a 20% return as opposed to a 15% return. So we're pretty good at using the money that people give us. It seems that, if we were going to sit down and try to determine what the actual status of Saxon Company is, we're very efficient with the use of our assets. We're very efficient with the use of the money that people give us to invest in the company. Where we fall short is in our profit margin, and the profit margin has nothing to do with the assets. Comparing our income to assets, it's looking at our net income versus our sales, right? So it seems that we have a few expenses out there that may be out of line. That maybe we are paying our employees more. Maybe we have too much selling and administrative expense. I would not think that it has anything to do with depreciation, because we seem to be making very efficient use of our depreciation. But there is an expense out here somewhere that is out of line. So if I was the finance director and I was looking at the performance of our company, that is where I would suggest that we try to find some improvements. Now, maybe we've just decided that we're going to pay our employees more because that gets us better employees. And maybe this is a well thought out position that we're in. And maybe by paying our employees more and having better employees, that gives us the ability to get better returns on the investment. If that's the case, then no changes are needed. You know, if you have made a conscious decision to go in a particular direction, and then when you do your ratios, it shows that, yeah, you went in a particular direction, then that's not a bad thing. That means you carried out your plan. Okay, so if our plan was to have better paid, better employees, then I guess we were completely successful and no changes in our business plan are required. If this was not something that was designed, it was not something that was desired, then maybe we need to look back. Maybe somebody is not being as efficient as they could be. All right. Let's move on to the next category of ratios. The next category of ratios is asset utilization ratios. All right, so we have 1, 2, 3, 4, 5 of them here. And the first one is receivable turnover. Receivable turnover is sales over receivables. Okay, so sales is $4 million. Our receivables are $350,000. Okay. Give me 1 second here. Okay, false alarm. So anyhow, receivable turnover, 400,000 divided by $350,000. So our sales over our receivables. When we do that division, we end up with 11.4. What does that tell us? It tells us that we are able to turn our receivables over 11.4 times during the year. $4 million worth of sales, only $350,000 worth of receivables. That means that what's in our receivables now is 11.4, you know, the sales are 11.4 times the number of our receivables. That means that we are turning our receivables over relatively well. Okay, you want that number to be something around 12, basically, right? If your terms are net 30 days, then you should be turning that over basically once a month, right? So that should be 12. So a number of 11 is actually pretty good. Industry average is 10, so we're actually beating the industry average there. We really don't have a whole lot to complain about. The next ratio is average collection period. All right, so the average collection period. So what we need to do is then take our accounts receivable and divide that by our average daily credit sales. All right, now we don't have that number. That's not on any of these statements that we're looking at, average daily credit sales. So we have to calculate that. The way that you get average daily credit sales is to divide the sales by the number of days in the year, okay? So we have $4 million worth of sales. Now, I'm going to let you in on a little secret here. In the finance world, there are not 365 days in the year. For purposes of making the math easier, we tend to just assume that there are 360 days in our years. You know, so basically we're going to say there's 30 days in every month, 360 days. Yeah, I know. In the real world, there are 365 or possibly 366 days in your year. But let's just agree right now that whenever we end up having to do something to figure out a daily number, we're going to assume that there are 360 days in the year. Okay, so we take the full year sales, assuming that everything is on credit, and divide that by the number of days, 360. That gives us our 11,111, 11111 is our daily credit sales. So getting back to the average collection period, we take a look at our accounts receivable, which is the $350,000 right there. Divide that by our 360 days. No, I'm sorry, by our $11,111. The answer is 32. Okay, so at least what is in accounts receivable here at the end of the year, this $350,000, it represents 32 days worth of sales. So that means that we are collecting our receivables every 32 days. Okay, now, once again, the goal here is probably 30 days. Very few people are going to pay early because there's no incentive to pay early. You're going to have people who sometimes pay a little bit late. You're going to have sometimes people who pay a lot late. So your number is probably going to be above 30. 32 is not terrible. Okay. Now, as the finance manager, you're going to look at that 32 and you're going to go to the accounts receivable department and you're going to say, that number is supposed to be 30. What's wrong with you people? Knowing in your heart that they're actually doing a pretty good job, but your job is to get everybody motivated to do their job better. So you're going to tell them you want that number pushed down a lot closer to 30. Because that's your job, okay? If we look at the industry average is, they're telling us in the book, is 36 days. So for us to have 32 days worth of receivables in there instead of 36 days is a good thing. Okay, like I said, you're going to put a little bit of pressure on your accounts receivable department. Nobody's going to lose their job over this, and you probably should give them a raise or a bonus because they're doing a pretty good job. All right, inventory turnover. Inventory turnover. This is going to be sales over inventory. Okay, so sales are $4 million. Inventory is $370,000. Okay, so it's going to be 4 million divided by 370,000. That's going to give us 10.8 as our ratio. So that tells us that we are turning our inventory over 3.8 times per year. Not 3.8, 10.8 times per year. Okay, so we have less than a month's worth of inventory in inventory. Okay, now, once again, is that a good number? Is that a bad number? It depends on what you are, how you're running your company. Okay, if you are running your company trying to be as lean as you can, as far as carrying assets that you don't want to have to pay for, because, hey, if I reduce the amount of inventory I'm carrying, that gives me more cash, right? So in a cash flow world, having lower inventory is much better for me because I'm going to have cash available. But you have to make sure, you know, the whole point of this is that you, as the finance director of the company, you are not the only person that is running the company, right? You've got people above you and you've got other people who are kind of on an equal term with you. Okay, so you're the finance director and you're making decisions as to how much money, how money is being dealt with in the company. For you to make the decision, if they left it up to you to make the decision as the finance director as to how much inventory, you're going to tell them you want the inventory to be as close to zero as possible, because as far as you're concerned, that is costing you money. Yeah, that inventory costs you money. It costs you money in the fact that you don't have cash because you have cash invested in that inventory. And also, you're probably borrowing money in order to pay all of your bills. You probably have some sort of debt. So if you didn't have that inventory, you would have less debt. So if they left it up to you, you would tell everybody that inventory is going to be down as close to zero as we can get it. And that really is going to be your advice. You're going to tell everybody, I want that inventory as low as possible. Well, the production manager for the company is going to have a different set of goals than you are, right? He is going to want to make sure that he has enough inventory in stock so that he never has to shut the plant down. It's like, oh yeah, well, we normally carry this amount of inventory and we're really happy with carrying that amount of inventory, so no problem. Well, then all of a sudden you have an increase in sales. You know, the salesman found a terrific new customer that wants your product, and you have sales this month that are bigger than you've ever seen. Well, the production manager is going to want to buy more inventory to make sure that he has the raw materials to manufacture the product when it's needed. There's nothing worse than the manufacturing process coming to a halt because you don't have the raw materials. Well, I'd like to be making more widgets, but we ran out of steel. We underestimated what our inventory needed to be. That damn finance guy wouldn't let me have more inventory. So here we are. We increased our production, and all of a sudden we've run out of steel. So how profitable is your company going to be if you are shut down because you don't have inventory to process your product? You're not going to be profitable. You're losing profit on those days that you are shut down. What's going to happen? Oh, you're probably going to lay off your employees. You're going to tell them to go home for a couple of days. You don't have any work for them. That's going to irritate them, and they're not going to like the fact that they've lost pay because you don't know how to run your company. You're going to end up still with your fixed costs on the days that you're not operating. You're still going to pay the electric to keep the lights on. You're still going to pay the gas to keep it warm. You're still going to pay the depreciation on the machines. You're still going to pay the rent. So shutting down is a terrible, terrible thing. So here's your conflict. Finance director, I want that to be as small as possible. Manufacturing manager, I want to have a lot of inventory because I want there to be a buffer so that I never run out. So somehow the two of you have to come up with some sort of a agreement as to how much inventory is going to be kept. Okay, and you can set any kind of parameters you want on that. We'll talk about stuff later on in the semester, but understand you want that inventory as small as possible, but there is a number at which it becomes ridiculous and you can't run the company anymore. Okay, so once again, let's take a look at what we did here. We turned our inventory over 11.8 times. So we have less than 1 month's worth of inventory in there. That's probably pretty good unless you were trying to be more aggressive. If you're trying to be more aggressive, and we'll talk about just-in-time inventory later on. Just-in-time inventory is basically you have a really good relationship with your suppliers and you're able to get the inventory, the raw materials shipped into you a day or so before you need them. It can be done. There are companies that do this, but I'm thinking that in this the world that we're in right now, with all kinds of supply chain interruptions and such, companies that were doing just-in-time inventory are probably suffering. You have to have something in the warehouse so that you can keep working if the trucks don't come in. Okay, so 10.8, you have less than a month's worth of inventory. If that was your goal, great. If your goal was to have it be less, you know, a smaller or a larger turnover, that you have smaller inventory, then you take that number and you work with it. You try to figure out what went wrong to reduce your inventory so you can get to the ratio you're actually looking for. Just to let you know, out in the industry, the average is 7 times. So you turning your inventory over 10.8 times means that you are being a lot leaner than your competitors. This is pretty consistent. If we take a look at what we've seen about Saks and Company so far, we seem to not have the same profit margin because maybe we're paying our employees more. You know, that, let's say that that's the reason, so it's not a surprise to us, but we are finding that we're utilizing all of our assets much more efficiently than our competitors. So us having a 10.8 turnover as opposed to a 7 times turnover that our competitors have, that's consistent with what we seem to be doing with the company. More efficient use of our assets. All right, fixed asset turnover is number 7. The fixed asset turnover is sales over fixed assets. All right, so sales still $4 million. What are our fixed assets? Fixed assets are $800,000. Let's see where they got that. Plant and equipment right here, $800,000. This is net plant and equipment. So that's going to be our historical cost, less accumulated depreciation, right? So it's net plant and equipment. So 4 million divided by 800,000 is 5. So we're turning over, we basically have 5 times our plant and equipment. If we look at the industry average, it's 5.4. So we are less, our ratio is less than our competitors here. So, all right, I guess what we're seeing is that this company has some expense out there that is out of line with our competitors. Maybe we're paying our employees more to get better employees. And we have slightly more asset involved. At least we're not turning over quite as much as our competitors. So we made a decision to have more efficient machines and more efficient employees. Okay. You know, if the number comes as a surprise to you, then you need to look at it. But if you planned on being in a particular position and your numbers, your ratios show that that's where you are, then that's just right. You know, it's just verifying that you're doing what you're saying you want to do. All right. And the final asset utilization ratio, number 8, is total asset turnover. So that's going to be sales over total assets. Sales are $4 million. Total assets are $1.6 million. See here, net assets, 1.6 million. So 400,000 divided by 1.6 million is 2.5. The industry average is 1.5. So the other assets that we have, we're making better use of them than our competitors. Well, what does that tell us? Let's take a look at this, okay? Once again, we're not just doing these ratios because we're looking for something to do, because we have nothing better to do than do some math in our spare time. Because I know that that's how everybody lives their lives. You know, oh, I've got some spare time. I'm going to do some math now. We're doing the math because we want to learn something. Okay, so we saw that the ratio of sales to our plant and equipment, that we were a little less efficient than our competitors. What are the other assets? Well, the other assets are cash, marketable securities, accounts receivable, and inventory, with the big ones, of course, being accounts receivable and inventory. So what that tells me is that we're overinvested in our plant and equipment as compared to our competitors, which once again, it may not be a bad thing. It may be that was our desire to make better use of and have better equipment and more efficient equipment and better employees. That's fine. But as far as all of the other assets, we are significantly more efficient when you take a look at total assets, and that would include the accounts receivable and inventory. Now, that, once again, should not come as a surprise to us, because if you looked at the other ratios where we were talking about how efficient or how many times we turned over our accounts receivable and how many times we turned over our inventory, we were better at that than our competitors. So we're so much better at turning those particular assets over that it more than makes up for the fact that we're overinvested in plant and equipment. We turned over our total assets 2.5 times, where the industry average is 1.5 times. Excuse me, we're significantly better at managing our accounts receivable and our inventory than our competitors. Okay. Like I said, we're not just doing these ratios for the sake of doing ratios. All right, so we have one more group of ratios to worry about here. And that is liquidity. Oh, 2 more, I'm sorry. Liquidity ratios. C, there's 2 liquidity ratios that we're going to worry about. The first one is the current ratio, and that's going to be current assets over current liabilities. Now, once again, like I said, it's great to have these totals here, these subtotals, because this is going to help you when you do these ratios. So you have all of your current assets listed, then you do a subtotal of current assets. So we have current assets of $800,000. And then you, on the liability side, you list your current liabilities, accounts payable and notes payable, total current liabilities of $300,000. So our current asset is going to be 800,000 over 300,000, or 2.67. Industry average, 2.1. Okay, so once again, the bigger number is the better number in this particular set of equations. What is this telling us? Okay, why do we care about the current ratio? Who do you think, who else out there is concerned about these liquidity ratios? I'm going to stop sharing for a minute so I can see you guys. Who do you think is concerned with our current ratio other than the management? Peyton, what do you think? Oh, go ahead. Owen, go ahead. Can't hear you.
Creditors.
Creditors, absolutely. The bank wants to make sure we have the ability to pay off our loans, right? Our vendors want to make sure we have the ability to pay off our lines of credit that we have with them. So they're going to be very concerned that we have current assets that we can turn into cash to pay those current liabilities. Absolutely. So this is one of those things where when we give our financial information to various other people, and keep in mind, you know, if you have a banking relationship and you owe significant money to a bank, you know, if I was $1 million company, I have $1.6 million in assets, and I had a $5,000 loan at a bank, you think they're going to require me to give them bank statements all the time, or financial statements all the time? Probably not. But if I owe the bank, you know, 500,000, 400,000, 300,000, something like that, you think they're going to want to see financial statements? Absolutely. You know what they're doing when they look at those financial statements? They're doing these ratios. And I'm pretty sure that, you know, and I don't know that we talked about this very much, but we have what are called loan covenants. There are certain covenants, promises. A covenant is a promise. If you made a promise to the bank that you were going to behave in a certain way, the way that they test whether you're doing what you're supposed to is by doing these ratio analysis. Okay, so the bank says, okay, we're willing to remain as your bank and let these loans be out there unless your current ratio falls below a certain level. And there's some sort of a lending standard that the bank is going to have. So if ours is 2.67, you know, the industry is what, 2.1, I think I'm reading. If that's the case, 2.67 current ratio versus industry average of 2.1, that's great. It's almost a half of a percent higher. So that means we have a lot more current assets over, you know, we have an excess of current assets more than our competitors even. Okay, so our banks are going to look at that. They're also going to look at the next one, which is the quick ratio. The quick ratio, and I'll go back to sharing again. The quick ratio is current assets minus inventory over current liabilities. Okay, this is the quick ratio. So current assets, right there, 800,000 minus inventory of 370,000 tells us that we have 430,000 of current assets that are basically cash, marketable securities, and inventory, or excuse me, receivables. We took inventory out over our current liabilities. Now, what is this telling us? Okay, the current ratio and the quick ratio. What is it really telling us? Well, and like I said, it's our creditors, Owen said, it's our creditors that basically want to know these numbers. Well, if everything went into the toilet, just we have no more business, everything's shut down immediately, are we going to be able to pay at least our current creditors? Well, Our accounts payable, our vendors want to make sure that they're being paid. Notes payable, the people that we borrowed money from, they want to make sure that we have the ability to pay those notes. Okay. Well, where's that money going to come from? Where are we going to be able to raise cash relatively quickly? Well, that's why current assets are listed as current assets, because these are assets that theoretically we can turn into cash relatively quickly. All right, cash is cash. We've got $30,000 in the bank. Would our creditors prefer that to be more? Probably, but then again, that might not be a good business decision. Marketable securities. Can we turn marketable securities into cash relatively quickly? Yeah, that's why they're called marketable securities. In theory, we should be able to get them turned into cash in a matter of a few days. Okay, so as far as our creditors are concerned, we've got basically $80,000 in cash equivalents. Accounts receivable and inventory, which is going to be turned into cash quicker? Accounts receivable is going to be turned into cash quicker because in theory, we're collecting these accounts receivables every 32 days. That's what we calculated earlier. So inside of 30, just around 30 days, we should be able to raise another $350,000. So if you look at the quick ratio, you're looking at these numbers here, which represent numbers that you could have in cash within the next 32 days. Against our current liabilities, which are liabilities that are due in the next 30 days. So we have a quick ratio of 1.43. So almost 1.5 times what our current debts are in assets that can be turned into cash in 30 days. Now, inventory is also a current asset, but it's unlikely, at least in the business cycle, that we're going to turn the inventory into cash in 30 days. Because one of the things we're going to see further on in the course is that looking at the business cycle, there's a period of time, what we're going to do is we're going to measure the time from when we receive our inventory in the door to when it's turned into, work in process versus, finished product versus sold product versus accounts receivable turned into cash. That period is obviously longer than the amount of time it takes to collect our accounts receivable because we have the manufacturing process and the sales process that we also have to take into account. So maybe it takes us 60 days to turn inventory into cash, 30 days to get the product in. Well, actually, we could probably take a good guess at it right here because our inventory gets turned over how many times? 10.8? 10.8 times during a year. So that's less than 12. So it's going to be less than a month. So it's going to take us, let's just throw a number out there, 21 days, 3 weeks to turn the raw materials into finished product, and then another 32 days to collect it. So we're looking at, let's say, just roughly around 60 days to turn inventory into cash. Okay, well, once again, our current ratio, in 60 days, we'd be able to pay these people, 2.67 times. In 30 days, we'd be able to pay these current creditors 1.47 times, almost a time and a half. So we're sitting pretty good here as far as liquidity goes, especially when you compare us to our competitors. All right, now the final set of utilization ratios is the debt utilization ratios. Okay, so the first one is debt to total assets. So that's going to be very easy. Total debt over total assets. So total debt is found on our balance sheet here, liability section. Total debt is going to be liabilities of $600,000. Okay, accounts payable, notes payable, and long-term liabilities, $600,000. Compare that to total assets of $1.6 million. That gives us a ratio of 37.5%. So we have debt of 37.5% to our asset ratio. Now, industry average is 33%. So we're a little high here. We are operating with a little bit more borrowed money as opposed to equity. Okay, so we've borrowed money where our competitors would have sold additional equity. Okay, once again, We'll see later on when we do leveraging, that may be a very legitimate decision, because if you take on more debt to acquire your assets, you're leveraging your company, and in good times, that will give you a much higher profit margin per share, earnings per share. But in bad times, it's a bad decision. So take that with a grain of salt. Once again, if that was your decision, that's great. We've verified that you're actually at that position. Excuse me, if that happened by accident, nothing should happen by accident, should it? All right, number 12 in our ratios is times interest earned. So this is the number of times that interest is earned. So the numbers that we have here, and these are also numbers that we're going to have to calculate a little bit. It's income before interest and taxes divided by interest. So income, we have to go back up to the income statement. So income before interest and taxes, that number is right there. The $550,000 under operating profit. See, then we subtract out the interest, and then we subtract out the taxes. So this is basically EBIT, isn't it? So it's going to be EBIT over interest. Earnings before interest and taxes over interest. And interest expense is right here, of $50,000. So we're going to divide 550,000 by 50,000. Our multiplier there is 11. So we have earned our interest charge 11 times. So we have operating income 11 times larger than interest. Okay. All right, that's fine. Interest, you know, that our creditors are once again interested in that number, because the higher that number, the better chance we have of the more credit worthy we are, the better chance we have of being able to meet our commitments, our requirements of making our loan payments to the bank. Oftentimes our payments are purely interest. We don't pay principal back, depending on how we negotiated our deal with the bank. If we don't make our interest payments, then we're in default, and that's going to cause trouble. We now can show that we are making more than 11 times of our interest payments. What does that tell us? That tells us we've paid all of our other expenses. We paid salaries. We paid for the raw materials. We paid selling and administrative. We've paid, everything except for interest and taxes. And we have, our income there is 11 times the interest that we have to pay. Banks should be happy. Okay, and our industry industry average is 7 times. So us having done that 11, having that number of 11 shows that we are a lot more creditworthy than our competitors. All right, and the final ratio that we want to talk about, and the end of chapter 3, as far as I'm concerned, fixed charge coverage. Now, this is another one that I would have to give you more information than just what is on the financial statements, because the fixed charges are not just what you see on the bank statements. Looking in the book, fixed charge coverage measures the firm's ability to meet all fixed obligations rather than just interest payments, on the assumption that failure to meet any financial obligation will endanger the position of the firm. And so the example that they give for Sachs & Company, in the present case, Sachs & Company has lease obligations of $50,000 as well as $50,000 in interest. The total fixed charge financial obligation thus becomes $100,000. We need to know the income before all fixed charge obligations. In this case, we take back income before interest and taxes and add back the $50,000 in lease payments, because we can't just look at net income, because the net income has both the interest and the other fixed charge, the rent, already out of it. So what we would have to do is we would have to go back to the income statement, go back before taxes, before interest payments, back to EBIT, the $550,000 of EBIT right here, then add back in the fixed charge of the rent, We don't have to add back in the interest because we haven't taken that out yet. This is earnings before interest and taxes. So this 550 already has $50,000 worth of rent expense deducted from it. So we would add that back in. So it would be the 550 plus the 50,000, giving us $600,000 of income before fixed expenses. Divide that by our fixed expenses, which we know is the interest, plus that $50,000 in rent expense that that the book has given to us. So now we're going to end up with 600,000 divided by 100,000, or a factor of 6. So we earn all of our fixed charges in a factor of 6. Remember, we earned our interest 11 times. This is different. This is the fixed charges. So we've earned back our fixed charges 6 times. Once again, if we didn't pay the interest, the bank would shut us down. If we don't pay our rental charge under our lease, then the landlord is going to shut us down. Either missing any of those payments is going to endanger the company. So bank wants to know, what are your fixed charges that you need to meet? You have to have rent of $50,000 and you have to have interest of 50,000. That's 100. The adjusted income is 600,000. So you earn it 6 times. Industry average 5.5. So once again, we're a little bit stronger than our competitors. All right, those are the 13 ratios that are in your textbook and that I want us to be responsible for. All right, so on Tuesday, and as I said, it's fully expected that I will be back on campus. Our class is in AC 40. We haven't done that yet this semester, but we will be in AC 40. It's a big classroom for a small class, but that's all right. We'll have the exam. It will only be the exam that we're going to be doing. Expect to answer questions about the role of the finance director. Expect to be able to put together an income statement from information that I give you, to be able to put together a balance sheet from information that I give you. Certainly expect to be able to do the cash flow in the 3 steps, the way that we went through it in the book, the operating, the investment, and the financing sections of the statement of cash flows, and also be able to do, I'm not going to give you, 13, I don't think. I'm not going to make you do each and every one of these, but please put yourself together a cheat sheet with all of the ratios on it, and I will give you a company, I'll give you a financial statements and information, and you'll be required to calculate out the ratios based on the financial statements that you have. I'm hoping that as we go through this, and as you saw, I wasn't just teaching you when we were talking about the ratios, I wasn't just saying, okay, here's the math. Blah, 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 blah. I wanted to be able to look at what the ratios are trying to tell us. Do the analysis. As the finance director, yeah, it's going to be your job to make sure that those ratios are calculated, but you should be able to interpret them also. Okay, knowing what's going on with the number of times we turn over inventory, it tells you whether your plans are right or not. You shouldn't just be doing it on a random basis. Well, we'll just get as much inventory as we think we need. You should be able to project what kind of inventory you need. You're going to have to work with other people in the company. You're going to have to work with the production people to find out, what kind of inventory do they need? How much of it do they need? How much of a lead do they need, just in case there's an interruption in the supply chain? How much, because you don't want to shut down. You don't want to be the person that has to explain why the plant is shut down today. Okay. Oh, I didn't want to pay for inventory, so we didn't have inventory. Sorry about that. Well, you lose your job. Plain and simple. If you cause the plant to get shut down, you're probably going to lose your job, because that's a big mistake. I wanted to try and explain what each of the ratios is all about. We do these things because they're tools. We want to be able to interpret them. We want to be able to show whether a company is doing what we've planned. Okay. None of these numbers should come as a surprise. If it comes as a surprise, then somebody didn't follow through on a plan. you shouldn't be surprised. You should be verifying that what you're doing is what you're doing. We want to try and keep in our accounts receivable as small as possible. Then you have to really get on your accounts receivable people to make sure that they could collect the receivables. Okay. Anyhow, I'm out of time. It's 10 to 11. Like I said, expect the exam on Tuesday. Expect it to be an AC 40. If there's any changes to that, I will let you know. You can bring your calculator. You can bring your cheat sheet. Beyond that, you should, as we discussed earlier, you should have the formats of each of the things we talked about: the income statement, the balance sheet, probably the statement of reconciliation of retained earnings, and the statement of cash flows. You should have the formats memorized so that you'll be able to do it, and it'll show up in the form that we want to see. Any questions?
Yeah, two questions, Professor Kowalczyk. Both related to the cheat sheet. Is the size of the cheat sheet A4?
I don't care how big your cheat sheet is. Just make it. Just try to have be only the ratios. I guess if you want to put down the formats of the forms too, I guess I'm not going to run around and check everybody's cheat sheet.
Okay. All right. Then I guess me asking whether double-sided doesn't really matter then. Thank you.
Nope. You could take it. You know, I've heard of people that said, "Oh, you're allowed to have a 4x6 index card," and then all that does is teach you guys to write smaller. So, yeah, a sheet of paper that should be able to do what you need. Any other questions? All right, guys. That's all I have for today. We'll see you on Tuesday. I should be back in my office on Monday for my office hours between 10:30 and 2:30. So if anybody wants to stop by, I should be there, and we can talk about any issues that you have. Otherwise, we'll just see you on Tuesday.
Have a good day.
Thanks. You too.
Have a good day, Professor Kowalczyk. Stay warm.
Thank you. See you.
Professor Kowalczyk,
Yes, ma'am.
you said about knowing the role of the finance director. Is that going to be almost like an open-ended kind of question, or is it just?
Yeah, I think it's. I have an essay question or two on there that basically, you know, and it's one of those ones where just basically give a decent answer. You know, I'm not going to require you to spit back exactly what's in the book, but just an understanding of some of the functions. That's all we really need.
Okay. All right. Sounds good.
All right. See you Tuesday.
Yep. See you. Have a good day.
Okay. Bye-bye.